Yeah.
Satish
Good evening, everyone.
One minute, we'll have to.
Yeah, I have come.
Yes,
Okay.
Satish.
Okay.
Hello, Kem show.
Sorry.
Sorry, I did not receive the link.
Yeah.
I did not register. That is the reason,
No issue.
No
Thank you,
problem.
sir. Thank you.
Okay. Good evening, everyone. I, on behalf of Sri Lohana Mahaparishad CA and Professional Committee and the Malad Chambers of Tax Consultants, welcome you to the session of practical aspects on NRI taxation. We have our dignitaries, Sri Satish D. Vithalani, LMP President, Advocate Rinav Thakrar, MCTC President, and our guest, Dr. Bharat Vasani. Sir, we welcome you on behalf of all the committees. Sir, would like Satish sir to share the thoughts, speak few words for our audience today. Satish sir.
Thank you. Good evening to everyone. Jai Shri Krishna. Thank you so much, for giving me an opportunity. आज जैसे ना तैयार भाणे बेसवानी आदत पड़ी गई છે. ભરતભાઈ ખૂબ મહેનત કરે, નટુભાઈ કરે અને બધા મહેનત કરે, બધા મહેનત કરતા હોય અને તૈયાર ભાણે બેસી અને બે શબ્દ કહેવાના મને એની અંદર that with the learned people like you, because I could see more than 70 people, but one thing I contributed that I have made this subject known to about 37 countries, that this is across the globe. Everybody knows that we are talking about NRI taxation today and complications. The tax laws are not so simple. અને મને લાગે છે કે એ લોકો કદાચ ટેક્સ એટલા માટે બી સિમ્પલ નહીં રાખતા હોય કારણ કે ઘણા લોકોને એમ્પ્લોયમેન્ટ આપવાને મળતું હશે ને પીપલ આર પ્રેરાતા હશે કે વધારે લોકો ચાર્ટર્ડ એકાઉન્ટન્ટ થાય. અને આઈ થિંક અવર ગવર્મેન્ટ ઓલ્સો ઇઝ એક્સપેક્ટિંગ કે બધા જે છે ને બિઝનેસમેન અને પ્રોફેશનલ્સ બી અધર દેન ચાર્ટર્ડ એકાઉન્ટન્ટ્સ આર ઓલ્સો chartered accountants. This is how we are treated. Bharat, I'm sorry. I am a aggrieved party. I'm supposed to be talking, from my point of view. But one thing is for sure, એની અંદર કે લગભગ કોઈ બી જગ્યાએ જાઓ તમે you find એની અંદર હું હમણાં સોસાયટીની અંદર હતો. I just bought a flat in one society. And who has come as a consultant? First of all, registration માટેના consultant હતા એ રાયચુરા એટલે લુહાણા હતા. પછી then I went for one more thing એની અંદર અમારા લોકોને જે આઉટસોર્સ કરવાનું હતું એકાઉન્ટ્સ કમ્પ્લાયન્સીસ ને સો ઓન તો બીના એન્ડ કંપની આવી મેં કીધું પછી મેં એને બીનાને કીધું ડુ યુ નો દેટ આઈ એમ ધ પ્રેસિડેન્ટ ઓફ લુહાણા મહાપરિષદ મને કે આઈ એમ નોટ કનેક્ટેડ. ઇફ યુ આર નોટ connected with Bharatbhai, then it's your big loss કરીને. So yesterday I could get her connected. I'm sorry, this is a meeting, you're going to be talking, talking about the NRI tax laws and other things. But what I'm trying to say is that, તમે લોકો બધા ભેગા મળીને જે સેવા કરી રહ્યા છો ને એની અંદર I really have no words to express, my gratitude. કારણ કે આજ બધા તમારા બધા માઇન્ડ ભેગા કરી અને હું ને ભરતભાઈ ને શું કહેવાય આપણે નટુભાઈ, દિનેશભાઈ કાનાબાર and so many others, have been breaking our heads, ત્યારે મને ખબર પડે કે the world is not so simple. We have been getting good help from Bharatbhai's office also.
Yes.
But we are very grateful to all of you that you are doing an excellent job. ભગવાન તમને ખૂબ સારું સ્વાસ્થ્ય આપે અને ખૂબ ભગવાન કરે તમે સેવા કરતા રહ્યો એની અંદર અને ખૂબ વધારે આપણા લોકો ચાર્ટર્ડ એકાઉન્ટન્ટ થાય. You people are a great support. This particular framing 1200 નું એક ગ્રુપ અને મારે કોઈને કાઢતા રહેવું પડે છે એની અંદર ટુ accommodate somebody in the group. અને બીજું 500-600 નું ગ્રુપ એની અંદર. ભરતભાઈ આખું આજે probably one of the best professional groups of all over Lohana Mahaparishad group any under, and a wonderful job you are doing. દીકરા કે દીકરીઓ even કદાચ જે છે ને તમારી આર્ટિકલશિપ કરતા હશે એ દીકરા કે દીકરીઓ કે કદાચ પાસ બી થયા હશે 1 વર્ષ કે 2 વર્ષની અંદર પોતાના પગ પર ઉભા થઈ જતા હશે because of this contribution of yours એની અંદર. તમે નટુભાઈ બધા બહુ સિનિયર લોકો અહીંયા આગળ છો એની અંદર. મને હું તમને જેટલા અભિનંદન આપું જેટલું તમને થેન્ક્સ કહું એટલું ઓછું છે એની અંદર. We really appreciate your work. બહુ ટાઈમ તમારો લીધો એની અંદર. But thank you very much for bringing me here. Thank you so much.
Yes.
I appreciate it.
Thank you, Satish bhai. Thank you, Satish bhai. Now would request Advocate Rinav Thakrar, President of MCTC, to give the opening remarks.
Thank you, Zankana. Good evening, everyone. On behalf of MCTC, I extend a very warm welcome to all the participants at today's webinar. MCTC now is in its fourth decade and continues to be a vibrant platform for knowledge sharing, professional development, and effective representations on issues that matter to the tax fraternity. Through our study circles, RRCs, seminars, and webinars, we ensure that professionals remain updated and engaged in continuous learning. In the recent past, our chamber has actively been making representations before the authorities, whether it is seeking extension in GST and income tax compliances or highlighting genuine hardships faced by the professionals. I'm glad to share that these efforts have been widely acknowledged, finding mention in the leading tax portals such as Tax Guru, TaxScan, and even Midday. It is also a matter of satisfaction that our representation recent on GST due date extension was promptly accepted, with the due date for filing of GSTR 3 being extended to 27th August. We remain hopeful of a similar positive outcome on our income tax representation as well. These successes strengthen our conviction that when we raise a united voice, it truly creates an impact. I must also place on record our gratitude to Sri Lohana Mahaparishad for their continuous support, President Sir Satish Vitlani Sir for his encouragement towards this CA and tax professional group under LMP, and to the ever approachable Dr. Bharat Vasani, who has always been a strong bond between this LMP and MCTC. And in fact, the initiator of today's webinar also. I remember the very next day after I was elected as president of MCTC, I received a call from Bharat sir asking કે રીનવ આપણે LMP અને MCTC નું joint webinar ક્યારે ચાલુ કરવા છે. So that is how passionate, approachable and supportive he has always been. And interestingly, I realized that I am the fourth successive Lohana president of MCTC.
Wow.
And both our esteemed speakers and the speaker and chairman sir are also proud Lohanas. With that, once again, I extend my heartfelt thanks to the entire Lohana Mahaparishad for their constant support. Nevertheless, friends, MCTC is not merely about events or representation. It is about nurturing a strong community of professionals where learning, networking, and service go hand in hand. Our committee members, despite managing their own independent practices, they serve the chamber purely out of passion, representing it honorarily, and giving back to the profession with commitment and dedication. I warmly invite those who are not yet members to join MCTC and be a part of this legacy. Together, we can continue to learn, represent, and grow stronger with our vision to connect, collaborate, and contribute. Thank you, and I wish you all an enriching session ahead.
Thank you, Rinav sir, for your kind words. And would now request Bharat sir to give us, pathway through and some additional remarks.
Yes. Thank you, Jankana. President LMP, Sri Satish Bhai, President MCTC, Sri Thakrar, today's learned speaker, Natwar and the Ujwal Thakrar. Really, we are fortunate that we are part of and we are doing activity with the MCTC since last 4 years of the inception. Our LMP CA and tax professional group is doing excellent since last inception of 4 years. We are a very 4-year child, but more than 1,700 members are part of this LMP CA and tax professional all over the globe. So really good things, a good activity we are doing. The purpose of starting this group to help the members who are coming in practice and helping those members who have the regular query. Daily, almost 15 to 20 queries we are resolving on WhatsApp group, and almost 15 to 20 different judgments are posted on the group daily. So I'm really fortunate that our LMP group is doing excellent for our members to be in practice. And I'm very much thankful to MCTC for being part of the webinar today, the first webinar of this year. And I'm sure that who members are attending this webinar today with the knowledge of our expert Natwar, Thakrar and the Ujwal are the expert in this profession. Even last year also they gave the lecture on the same practical aspect of the NRI taxation. Thank you all for the joining of the webinar. Thank you very much.
Thank you, sir. Uh, Now, the today's topic is practical aspects in for NRI taxation, which is rightly said by Satish sir and Bharat sir that it is a need of an hour. So we would request uh, to invite today's speaker, CA Natwar Thakrar and CA Ujwal Thakrar. Welcome, sir.
Thank you.
And yeah, would request CA Rima Shah to give speaker's introduction. Rima, over to you.
Thank you, Sankna ma'am. Good evening, everyone. Now it is my pleasure to introduce our esteemed and learned speaker, Mr. Natwar Thakrar today. He is a practicing chartered accountant and a partner in NJ Thakrar and Company. He specializes in the field of FEMA, international taxation, taxation of charitable trust, and taxation of foreign shipping and airline companies. He is also a member of International Taxation Committee of Bombay Chartered Accountants Society, the Chamber of Tax Consultants, and he was the chairman of the International Taxation Committee of the Chamber of Tax Consultants for the years 2018-19 and 2019-20. He is a regular speaker at various professional forums on the subjects of FEMA and international taxation. He has co-authored as well as contributed to various publications, including the companions published by the Chamber of Tax Consultants, Malad Chamber of Tax Consultants, the Institute of Chartered Accountants of India, the Bombay Chartered Accountants of India. All his publications relate to international taxations, FEMA, NRI aspects, transfer pricing, etc. Welcome, sir. Let me introduce our second speaker today, CA Ujwal Thakrar. He is also a fellow member of the Institute of Chartered Accountants of India and an LLB from Mumbai University. He has more than 14 years of post-qualification experience handling direct taxes as well as international taxation matters, including 5 years of work experience in the Big Fours. He has specialized in the field of non-resident taxation, transfer pricing, and taxation of charitable trust. My personal comment here, मुझे charitable trust में कुछ भी issues आता है, definitely call the Thakrars. He has made various presentations on the topic of transfer pricing, NRI taxation, public charitable trust at the Institute of Chartered Accountants of India, Chamber of Tax Consultants, and various study circles. He was the past president of the Malad Chamber of Tax Consultants for the year 22-23, committee member of the International Tax Committee of the CTC from past 7 years. He has also co-authored international tax books on the a compendium on the international tax by CTC. He holds a certificate of being appointed as social auditor by NISM, and he also holds a certificate by IICA for being appointed as independent director. Welcome, Ujwal.
Thank you.
Now I would request our President Reno Thakkar to present a memento. It's a virtual memento as of now, which will reach to you in some time.
Yes, we will get it couriered to you. So this is first for CA Natwar Thakrar, sir. Thank you so much for accepting our invite, sir. And for Ujwal Bhai. Ujwal Bhai, as Rima madam mentioned, he has been a past president of MCTC, and hence he is also always guiding us as a past president. So thank you Ujwal Bhai also for accepting our invite.
Thank you very much.
Thank you. Over to you, Ujwal sir.
Over to the speakers.
Yes.
Over to the thank you.
Yeah, thank you, Rinav, and respected Sri Satish Bhai, the president of Lohana Mahaparishad, Bharat Bhai, the president of MCTC, Mr. Rino Takkars, and all other members on the dais. In fact, it is indeed a pleasure to be part of the programs where MCTC as well as LMP are there, because these are our home grounds. I was also part of the management committee of the MCTC long back, but I could not reach to the position where Bharat Bhai or Ujwal have reached. But nevertheless, MCTC is our home. Today's presentation, Ujwal has very extensively prepared the presentation, and my role will be to, in between wherever some comments are required, I will be making the comments, but the lead role would be played by Ujwal, and that's all. With this, without wasting the time, I will request Ujwal to take over and proceed further.
Yes, thank you everyone. Thank you again, Satish Bhai, Reno, President of MCTC, for this opportunity. Today we will be dealing with the topic of practical aspects of NRI taxation. We'll try to make the session interactive. So if possible, please keep your answers in the chat box, and in between when we raise questions, if possible, Reno may, the participant may unmute themselves by raising their hands so that the session becomes more interactive. So before we start, how many, you can keep posting on the chat box, how many non-residents here, and if we may know how many, from which country. Please keep posting on your chat boxes. We see a lot of professionals present, but you would be happy to know if there are non-residents, and so we can take things in a more better way. Okay, we see many people from Dubai. Yes, because I think Dubai is one of the hot topics because of the deemed non-resident rule, which we will be covering. Then there are people from Singapore also. Yes, okay. What would we be covering today? Is the basis of charge for non-residents, determination of residential status under the IT Act, DTAA and FEMA. So all the definitions here are different, and many times people mix up. Say if people say I'm a non-resident under the IT Act, doesn't mean you would become a non-resident under FEMA or vice versa. So we will be covering that aspect. We will be covering dual tax residency and the resolution, tax incidence for non-residents under various heads of income, importance of TRC and DTAA benefits, TDS on payments to non-resident and procedure for lower withholding. And at the last, we have put some FAQs. Generally what people keep on asking the questions, and so we'll try to cover it, and obviously we'll take up the questions post that if time permits. So what is the basis of charge for a non-resident? So in India, we classify residents into basically three categories: resident and ordinarily resident, resident but not ordinarily resident, and non-resident. So in case of a resident, as we all are aware, the worldwide income is taxable. Whatever income which we receive, which accrues or arises or deemed to accrue or arise in India, worldwide income is taxable in case of a resident. In case of a non-resident and RNOR, income received or deemed to be received in India, and income which accrues or arises is deemed to accrue or arise in India only is taxable. However, for RNOR, the scope of income also includes income accruing or received outside India in case of a business or profession set up in India. So even if a person is RNOR, but if he is earning income from a business set up in India, then that much income which accrues to him out of the business also is taxable. We have taken a few examples for this for a better understanding in the subsequent slides. And as per section 92, where the country has a DTAA with India, the provisions of IT Act will apply to the extent they are beneficial. So whichever is beneficial, the non-resident can choose either to apply a DTAA or a local law. How do you determine the residential status? So as discussed earlier, definition under the IT Act and definition under FEMA are different. It is possible that a person resident in India but could be a non-resident under the other act and vice versa. And resident under the IT Act may not necessarily mean that the person is also determined as a resident under the DTAA or FEMA. We will take the definitions so that there will be a more clarity on this subject. Determining the scope of taxable, what is the relevance of the residential status? As discussed, the residential status is important to determine the scope of taxable income, availability of special rates. There are certain special rates given to non-residents. So we need to first determine the residential status, and there are also treaty reliefs given based on the residential status. What is the relevance of residential status under FEMA? Permissibility of transactions under FEMA, that is, what are the liberalized remittance schemes applicable to the person? Either LRS is applicable or USD 1 million scheme is applicable. Designation of bank accounts, say whether he can maintain local savings account or needs to convert to NRO NRE account. And availability of tax exemptions also. So if a non-resident can avail tax benefits for NRE and FCNR deposit accounts, which are tax-free. What are the supporting documents required to determine the residential status? The type of visas, passport copies with arrival and date stamps. For example, the type of visa also determines if you are going for an employment or whether you are going for a business or personal visit. This is more important for definition of under FEMA, the intention. What are the determining factors for a non-residence for residential status? See, in case of an individual, physical presence, there is citizenship and income from sources, and whether he is liable to tax in India are the determining factors. So a few years back, only physical presence test was there. So if a person, say, was not in India for, say, more than 182 days, then only physical presence was being tested. But from the last 4-5 years, say from financial year 21 onwards, citizenship criteria and liable to tax criteria were also added in the definition. And specifically, Dubai being a country where, does not tax individuals, this becomes more relevant to them. There are other countries as well, but people from Dubai generally keep asking questions about the citizenship and liable to tax. Then HUF form AOP. To determine the residential status, we need to see control and management. A non-resident where control and management of its affairs is wholly situated outside India. So, say in case of an HUF or a firm, if control and management is situated in India, then the HUF is said to be a resident in India. And if the same is outside India, it can be said that the firm or AOP is a non-resident. In case of company, place of effective management is important. And case of others, control and management. So we will be focusing more on individuals today, the topic being the non-resident individuals. What is the test of residence for individuals? The first criteria, all of them are away, stay in India. If he stays in India for more than 182 days, if it is a yes, then he becomes a resident, and if no, a non-resident. However, there are further criteria also to determine the status. So in case he is a resident staying in India more than 182 days, then we need to also see the stay in India if it is less than 730 days in the preceding financial year. If yes, then he becomes RNOR. If no, then we need to see the criteria if he is non-resident for 9 out of the 10 previous years. If yes, then again he becomes RNOR. And if it is no, then he becomes resident and ordinarily resident. So why it is important to classify whether he is a resident, RNOR or non-resident? Because various reporting requirements, disclosures, taxability depend on whether you are RNOR, ROR or non-resident. In case of non-resident, say if stay in India is greater than 60 days, and so the criteria basically to become a non-resident is you should be in India for less than 60 days and the stay should be less than 365 days in the preceding 4 financial years. Then you become non-resident straight away. However, the criteria of 60 days stands extended to, if you see point 1, it stands extended to 182 days under the following circumstances. So, an Indian citizens who leave India during the previous year as member of the crew of the Indian ship or for the purpose of employment outside India, or an Indian citizen or PIO comes to India on a visit and whose income from foreign sources does not exceed INR 15 lakh. So why this exemption is given? Strictly speaking, when you see the 60 days criteria, it is very less number of days. So even if say a person say for the month of April and May is in India, then it would become very difficult for him to become a non-resident in the same year. So generally the exception is given so that if he plans to shift abroad for the purpose of employment or as the criteria is mentioned, or permanently settle there or these criteria, then the exemption is given that even if you were in India for say more than 60 days but less than 182 days, you would still become a non-resident. And a deemed resident definition was also added from AY 2021 and 2022. If India sourced income of the individual exceeds 15 lakh, then the 60 days extends to 120 days. So this definition was specifically added for an Indian citizen who is not liable to tax in any other country by reason of domicile or residence. Say for example, a country like Dubai, if there is no taxation in that country and if the person is an Indian citizen having Indian passport, so in such cases, if his India income exceeds 15 lakh, then he would be hit by this deemed resident criteria. And in such cases, the 182 days provided are reduced to 120 days. So we will see in the next slide what all changes have happened due to this definition.
Well, let's wait for a minute here because a lot of questions are here in on this particular previous slide, Ujwal. So there are so many questions. Especially some people have asked the questions about deemed residential status under 6(1)(a). So originally the residential status is determined under section 6(1) of the Act. However, from 2001 onwards, they have introduced section 6(1)(a), and it is for applicable to the persons who are citizen of India and who are not liable to tax in any other country by reason of their domicile, residence. So some people may be taxable in overseas jurisdiction, maybe on the basis of the source. Suppose I have an income in some income in USA. I've invested in stock market in USA. I've gotten a dividend income, and I'm taxed in USA, though I have not visited USA. So that is a tax on the source in USA. I'm not taxed in USA as a resident, but I'm taxed in USA on my source of income. So what section 61A says that if you are not liable to tax in any other country by reason of you being a resident of that country or domicile of that country, or any other criteria of a similar nature. So a criteria which makes you a resident under the domestic tax law, and you are liable to tax. So earlier, the liable to tax, there were a lot of controversies. Liable to tax does not mean actual payment of the tax. So as Ujwal rightly mentioned, that liable to tax they defined under the Income Tax Act and said that liable to tax means actual payment of the tax. So if you come to the situation of an UAE, if a person who is a citizen, because UAE does not give a citizenship to many people, and therefore many our Indians people who are residing in UAE are Indian citizens. And therefore, if we take the example that a citizen of India who is settled in UAE, he has not visited a single day to India in a particular year, but if he has an income in India which exceeds 15 lakhs of rupees, he is deemed to be a resident of India. So he is called a deemed resident, though under 6.1 criteria is not a resident, but by virtue of 6.1A, he is a deemed resident. And therefore, his status will be that of a deemed resident. And the section 6.1A very clearly provides that notwithstanding anything contained in 6.1, so it overrides 6.1. So that person is a deemed resident. However, if you go to 6.6D, so it says that such deemed resident will also be deemed NOR. That means being a not ordinary resident, as Ujwal mentioned in the very first slide, that being a R but NOR, he will not be liable to tax in India in respect of his foreign income, except in case of a profession that is set up in India and is earning income. Say, for example, our past president, Dilip Bhai, who is now in UAE. Let's presume that he has become a non-resident, but still he holds Indian passport. So in that event, if he has a practice which is set up in India, and if he earns any income in Dubai by virtue of his practice that is in India, then being a citizen of India, and if suppose presuming that he doesn't visit even a single day, being a deemed NOR, he'll be liable to tax in respect of the income that he earns in Dubai in respect of the profession that is set up in India, and he earns that income outside India. So that has to be kept in mind. Otherwise, that does not change anything. It does not tax your foreign income into India. If you want any income in Dubai, that is not taxable. But being after treating you as a person resident in India, probably government feels that they get certain other rights to question you during assessment proceedings, call for certain additional information. And the way this section was introduced earlier, so they introduced a different criteria, and after a lot of hue and cry, this has come in some absurd way. This provision has come in. But this is the situation. So many people from UAE keep on asking us the questions whether we come to India for 120 days or 182 days. That is a very common question. So that does not make much difference if they have a 15 lakh rupees income in India. If they do not have any income exceeding 15 lakhs of rupees, then it could make some difference about 120 days and 182 days. Because under 6.1A, if you're a citizen of India, you are not liable to tax at all in Dubai as a resident on individual personal tax. Then even a single day visit or even a zero visit to India for that reason will make you a deemed resident. But that does not mean, again, I'm repeating, that it will tax your foreign income into India, except the profession which is controlled or set up from India. Back to Ujwal, please.
Yes. So as we discussed, I have made an impact of the amendments of Section 8 at a glance. So what we need to see here is if the stay in India is less than 120 days, and income is more than 15 lakhs, still you become a non-resident. So either or of the criteria, you need to see if you are less than 120 days, then also you remain non-resident. In the second criteria, if your stay again is less than 120 days and your income is less than 15 lakhs, still you become a non-resident. In the third case, if you stay more than 120 days but less than 182 days and your income is less than 15 lakh, you would become a non-resident. There were few questions raised on this, so this would answer your questions. Your non-resident who is more than 120 days but less than 120 days in India, 182 days in India, and income is more than 15 lakh, so he will become a resident but not ordinarily resident as per the deeming fiction. And obviously more than 182 days he is a resident, any level of income. So as mentioned, that because of this amendment, the foreign income will not be taxable, but few disclosures and all become RNOR. There are few disclosures or additional questions which the officer can ask at the time of assessments, being an RNOR.
Because there are a lot of questions on these particular issues. Would you like to take up those questions, which are you address only those questions which are you covered the presentation,
okay,
so that it becomes more interactive?
Yes, so there are many other questions apart
So
from
say,
this.
so
Okay,
the first
the
question is
student
NRI selling land, so that you are going to deal with
that we will cover at the
later
subsequent
on.
slide. Now, students going outside India for higher studies, what will be the residential status? And some students take up part-time job also to support their expenses. Will this make any difference in determining the residential status? So firstly, we need to determine the number of days criteria as we mentioned here. So if he is a resident, his worldwide income would be taxable. So students going outside India, firstly, we need to see the number of days he is outside India. Depending, say, if more than 182 days, they would become a non-resident. And
no, Ujwal, student, see, normal criteria is 60 days stay in India.
correct.
60 days will get extended to 182 days under three circumstances. One is that he goes out of India for employment,
Correct.
or he goes out of India for business,
Yes.
or any other circumstances which, so these two criteria only. And third criteria is you being already outside India, you are on a visit to India, so already you are outside India means presumably there is a dispute. Being outside India means what? Being resident outside India, or just in 1 year you stayed for a few days and next year you come to India, whether that is deemed outside India. There are a lot of controversial judgments, but let's presume that you are already a non-resident, then you can visit India for 182 days or 120 days as the various criteria. So student, when he goes, he has not gone for an employment, neither he has gone for a business. Let's presume that he has gone abroad only on a student visa, and therefore he will be hit by 60 days criteria, and therefore he continues to be a person resident in India. Now he earns certain income abroad. So issue is that when he earns certain income abroad, whether that income will be liable to tax in India, and there are certain exceptions given. So that particular aspect we have not covered. But whenever during apprenticeship certain income is received, it is not taxed in those source countries, the students where they earn, because even say suppose students go to USA, even if they stay throughout the year, USA does not treat them as a person resident in USA unless they are resident aliens. So during the period where you stayed in that country as a student, I am particularly giving the example of USA, they don't treat such students as a residents in USA. And therefore, whatever income they earn, that will be treated as income earned by the non-residents of USA. And being resident of India, they can take benefit under India-USA treaty, and whatever income they've earned as an apprentice in USA, it could escape taxation in USA, but that student may have to pay tax in India. There are certain exceptions given under Section 10 also, that when you earn certain kind of stipends, you could still claim exemption. So we have not particularly covered that aspect, but there are certain benefits available under the Section 10, and if required, we can later on give a clarification on this particular issue. But student, by and large, remains a resident of India. Now, take an example: a student has not even stayed for 60 days in India. Then the purpose test is not required. If he stay in India is more than 60 days, then you have to see whether he has gone out of India for employment or business. But suppose he has not visited at all India and his stay is less than 60 days, then in that year you have been out of India. Whatever purpose you have been out of India is not to be looked in. You have stayed in India for less than 60 days, and therefore you become a non-resident in India. And therefore, once you are a non-resident, your foreign income will not be taxed in India. While whatever you earn in India is taxable, but foreign income is not taxable. And then, being a non-resident in 1 year, whenever you visit India, you can come to India for a period of 182 days. So issue will be in the first year, where you have to keep on examining whether he stayed in India for 60 days at all. If he has not stayed 60 days, then from that year onwards, he is entitled to visit India for a period less than 182 days.
Yes, so basically for students, this exemption of 182 days is not available. It is only in case of people living as a member of Indian ship or crew, or for the purpose of employment or setting or being permanently shifted outside India. For students, though there was a circular, but it is still a gray area as discussed.
No, circular is under FEMA. So that FEMA RBI is given an option to students under FEMA, whether student, because they borrow money, they lend money, sometimes they need pocket money, sometimes they, so under normally as a resident, you can't borrow from non-resident or you can't lend it to a non-resident. And they do a lot of other transactions. So there was always an issue whether student is a resident or a non-resident under FEMA. If you treat as a resident, then that student is committing a lot of violation under FEMA, which is very difficult to control also. And that was not the intention, that you punish students for doing this kind of things. So RBI issued a circular that where a student has stayed outside India in a year more than 182 days and is not totally dependent on parents for income, but he keeps on earning some income, then a liberal view may be taken and student may be given an option. So it's an option given to the student, if he has stayed outside India for 182 days, to consider himself as a resident or non-resident under FEMA. So in FEMA, if he wants to convert his accounts into non-resident accounts, if he has stayed in a previous year for 182 days, his accounts can be redesignated as a non-resident accounts.
Yes. So this, I think this was the relevant question for this. Also, one question was under the deemed status 15 lakh taxable income only or including non-taxable income. So this I will be covering in the next slides. So what do you mean by income from foreign sources? So income from foreign sources has been defined to mean income which accrues or arises outside India, except income derived from India from a business or a profession set up in India. So what income basically you should consider while calculating the 15 lakh threshold, or dividend or interest income in India, income from business, control or profession set up in India, capital gains from a property situated in India or shares in India, rental income from the property in India, or capital gains arising from transfer of shares or property in India. So these are the types of income which you need to consider for calculating the 15 lakh limit. What would be the examples of income not includable in calculating the threshold? Salary income received on account of services rendered outside India, dividend earned outside India, or whatever type of income which you earn outside India is not to be included in the 15 lakh limit. whether income exempt under Section 10 is to be considered. So such income should not be included while computing the total income for 15 lakh. This was the question which we have answered here. How do you calculate the physical presence for 182 days or 60 days or 120 days as given in the act? So it should be stay in India. It is not necessary it should be in the same city, same place. As far as you are in India, number of days are counted in India. Physical presence should be counted irrespective of the time spent on duty or purpose of stay. You could either come for travel or job or any other work criteria. The number of days will be counted, and stay need not be continuous. So you might come for 4 times, go out again. So these does not matter. Stay can even be on the territorial waters. So as per the definition, 12 nautical miles of India are covered. So even if you stay there, you will be considered as staying in India. And we need to see the criteria of April to March. Days of arrival into India and days of departure. So ideally both days should be counted. Many times, people are at the border, they ask, I got a timestamp after 12 p.m. Of that day. So which day should I count the day where I was on the airport, or which day should be counted? So ideally the date stamp we need to see which date the immigration officer has put, and both days are counted irrespective of you coming to India or leaving from India. Though there are various judgments on this, there are for and against, but we have mentioned, and I think both days should be counted as per the advance ruling authority. And there is a variable judgment which one says that only the day of departure has to be considered. So while checking the number of days, it is always better not to be at the border and keep 2 or 3 days more so that to avoid litigation on these aspects. And dates stamped on the passport are normally considered as a proof of date of arrival. Not liable to tax by reason of residence. So I have taken here an example where many people do not stay in the same country. Say they may be staying few days in India, few days in Singapore, few days in Dubai. So, and say, for example, if the criteria is 182 days in all the countries, so if a person says, say, for example, 90 days in 4 countries, so in such a case, he may become non-resident in all the 4 countries. So what would be and how is taxability and how will he be taxed? So let us take an example. Mr. A, an Indian citizen, stayed in India for 40 days, 130 days in Singapore, 110 days in England, and 85 days in Dubai, and has income exceeding 15 lakh. He was not resident in any of the above states due to less number of days as compared to the threshold period, and in such case he becomes a stateless person. As a stateless person, he is not entitled to Indian DTAA benefits, and citizen of India can normally be judged by a passport if he has a Indian passport. So in such case, he is not liable to tax by residence in any of the countries. However, as per the deeming provision, in such cases, he will become liable to tax in India because he is an Indian citizen, and this is how the deeming provision taxes such person.
under deeming provision, he becomes a resident of India. So income on abroad still, because he's not otherwise a resident of India, and he's deemed resident, but he's also deemed NOR under 6D and deemed NOR. Therefore, his foreign income will not be still taxed. It will still escape taxation, but for other purposes, he is a deemed resident. So, a lot of things, as you rightly mentioned, a lot of questions may be asked by the tax authorities to such state-led persons. Yeah, you can proceed.
So, what are the issues if he becomes a deemed resident? As we discussed that it is a non-substance clause, so it applies over and above section 6(1), and it covers even persons who would otherwise be resident or not ordinarily residents, and covers Indian citizens who are permanently settled abroad but not liable to tax. As we give an example, say person settled in UAE, because there is no personal taxation there. So even if he is not come to India even for say 2 days, he would still deemed to be a RNOR. Also, determination of residential status under the treaty. If a person is determined to be resident of another country under the treaty, he will become a non-resident in India. This will entitle him to benefits available under the domestic tax law and compliance requirements for DTAA. So if he is deemed to be RNOR, it will be mandatory for him to obtain a TRC to claim the benefit of treaty for that country, along with Form 10F, which needs to be filed by him. And it is mandatory for him to file the returns in India, even though there would be no tax liability due to DTAA benefits. Because to claim benefits, you will have to, though you may become taxable under the Indian law, but to say that you are not taxable, you may have to file returns by putting the relevant clause under which you are claiming the benefits. So what are the adverse impacts and what are the positive impacts? As we discussed, it applies over and above the section 6(1). Also covers citizen residing abroad not liable to tax. Includes income from business control or profession set up in India. They will lose the concessional tax rates and exemptions available only to non-resident, because when you are deemed to be RNOR, certain exemptions available only to non-residents are lost by that person. Or there will be denial of DTAA benefits for Indian sourced income. There will be increase in tax compliances like TDS obligations, tax filing returns. So as RNOR, you may also be liable to TDS obligations, and tax officer will have a greater jurisdiction. RNOR is still liable for TP compliance. Transfer pricing laws also become applicable if they are dealing in transactions with related parties. So, and reference to DRP is available only to non-residents. However, RNOR will not be eligible for DRP. So, DRP is a dispute resolution panel in India, which gives a faster resolution to the appeals, which will not be available for RNOR, which are otherwise eligible to non-residents. What are the positive impacts? Special slab rates apply to residents, senior citizens, also available to RNORs. TDS is deduction under section 195 would not be deducted and would be under the normal provisions. Foreign tax credit in India for doubly taxed income. Indian DTAA benefits become available for foreign sourced income, and no obligation to report foreign assets in ITR. So this is one of the main criteria, positive. So we take a case study, and your people are open to raise hands to answer this case study. Let me take you through the case study. CA Ramesh Subramaniam has set up a CA firm in Chennai, India since the last 4 decades. He now has shifted to UAE. His office is run by trusted employees in India, and he himself keeps on visiting in India for professional assignments. So, as we said, then there are a lot of CAs who have shifted outside India, so say Dubai, but still have their practice running in India. So, how do we tax, or what would be the tax liability of such person? Say he usually stays in India between 125 to 150 days. His Indian income, including income from business profession, is 10 lakhs. He has earned interest of 6 lakhs on NRI fixed deposit with SBI. So NRE interest is exempt, as you must be aware, but taxable for RNOR unless he is permitted to hold NRE account under the provisions of FEMA. He has earned consultancy fee of rupees 10 lakh from UK based client for services rendered in UK during his visit to UK. The fee was remitted to the UAE bank account. His professional income, which has accrued and received outside India, will be taxable in India if his status turns to RNOR. So what would be the residential status? So anyone who would like to answer this? We have taken a lot of examples. So anyone can raise their hands or maybe put answer in the chat box also. This would answer few of the question raised in the chat box. So Mr. KS had asked a question. So would you like to answer this? So we would also be clear if you have got answer to your question. Any answer to this or any raise of hands?
Ujwal, you can proceed because time is short. Huh?
Okay. So we go to the next slide. What is the residential status under FEMA? So person resident in India means a person residing in India for more than 182 days during the course of preceding financial year, but does not include person who has gone outside India or stays outside India for taking up employment or carrying out business or profession or for any other purpose in such circumstances as would indicate his intention to stay outside India for uncertain period. So as you would see, the person resident in India, your FEMA goes more on intention of the person rather than the number of days. The general condition here is 182 days. However, if he has gone outside India for Part A, such person is exempted from the general conditions and become non-resident immediately on the date of departure when his intention is to go outside India for either employment or business or vocation, or if his intention is to stay outside India for uncertain period, or when a person who has come to India, say a non-resident comes to India for employment or business or any other purpose to shift to India for uncertain period, then again his intention matters, and 182 days stay in India during the preceding financial year is mandatory. However, it even applies to returning Indians, even though required by RBI to re-designate NRI NRO accounts. So any questions here? As we discussed, FEMA
Yeah, Ujwal. So in this particular case, generally what happens, so there are two types of persons. One is a person who is, say, for example, a person is staying continuously in India, but he migrates to UAE. There are two types of persons who are migrating. One person is going for employment or business. Along with him, his family goes. So family, say, wife goes or children go. So when a person migrates outside India, so if you look at the definition, normally a person who is staying in India for more than 182 days during the preceding financial year is deemed to be a resident. However, this will not include. So when a person migrates outside India, either for employment or for business or any other purpose which would indicate his intention to stay for an uncertain period, he will be immediately become a non-resident. So under FEMA, it is a split residency. From the day he migrates, he becomes non-resident. So here, say, I am going for employment, but my children and wife are not going, but still they are going for an uncertain period because husband is going for employment. So obviously they are going to stay with them. In that event, they also become non-resident, unlike in income tax. When it comes to returning Indians, so a lot of people who are settled abroad now, they want and come back to India and return. So there is no exclusion from 182 days criteria. So what FEMA says that if you are outside India and you return to India, so you are already a non-resident under FEMA, and when you return to India, your residential status will be determined based on your stay during the preceding financial year. So if you are in the previous year, if you're in India for more than 182 days, then only you will become a resident in the current year. But if you've not been residing in India in the 482 days in the preceding year, and in this year you come, say, on the very first day of April, you have stayed for the whole year. Still, under FEMA, you do not become a resident because you have not stayed in India for 182 days. Now, there is a slight problem here because RBI in deposit regulation says that the moment a person returns, so it is talking about our own people, like Indian citizens or OCIs, they come back to India, they have to close their NRE accounts immediately or NRO accounts, and they have to redesignate as resident accounts, and therefore there was a lot of controversy. But recently, FEMA tribunal has ruled that 182 days is a mandatory provision for determinants of the residential status. So when people return, though they have to close their NRE, NRO accounts, but still under FEMA, the status is that of a non-resident. That means if they want to buy, say, agriculture property or do certain things which are not allowed to non-resident, those restrictions will continue to apply. In the very first year of return to India, they may not be able to buy agriculture property. They may not be able to do speculation in immobile properties, etc. So whatever restrictions which are applicable to non-resident under FEMA will continue to apply to such people, even if they otherwise under income tax law they become residents. That is the importance of this slide and explains the difference between income tax and FEMA. There is one question I hear also that a person moves out of India and along with the person goes for employment, but the wife does not go for employment or children don't go for the employment. So husband gets the benefit of 182 days, but wife and children do not get the benefit of 182 days. They will be hit by 60 days criteria in that event. And therefore one will have to be careful in determining the residential status under the income tax laws. Yeah, please proceed, Ujwal.
Yes, so as discussed, why we have included provisions for FEMA, because most of people do ask change of residential status, they need to redesignate their accounts as mentioned. From when you move outside India, you need to re-designate your bank accounts to NRO, NRE. And for returning Indians, as he has mentioned, you need to continue up to date you are still non-resident. Yes. Part 3 is dual residency and resolution under TTAA. So what do you mean by dual residency? This basically covers the first year when generally you move to a country. So a person can be resident of two countries under the domestic laws, especially in the year of departure and in the year of arrival. In such scenario, residential status would be assigned to one of the countries by either applying a tie-breaking rule as provided under DTAA. So, for example, in the first year, a person goes out of India, say in the month of. So, I think we have covered the example in the next slides. We will take it. DTAA by itself does not prescribe rules for tax residency, but it resolves the dual residency issues in the year of departure or in the year of arrival. And what are the hierarchies for tie-breaking rules? We need to see the permanent home, center of vital interest, habitual abode, nationality, and mutual agreement procedure. So by permanent home, we mean your residential home where the person generally resides.
So here in this example, let's take the example of that husband, wife and children. While husband goes out of India for employment, he will get the benefit of 182 days stay in India. The wife does not, and the children do not get the benefit of 60 days, the 182 days stay in India. So let's take an example that a person moves to Dubai because Dubai does not tax. So let's take an example that a person moves with family to Singapore. In that event, what happens? If husband has stayed for less than 182 days in India, he is a non-resident of India, and he might become resident of Singapore under Singapore domestic law. But as regards his wife and children, that 60 days stay will make them as a resident of India. Even if they stayed, say, 80 days in India and rest of the days in Singapore. So under Singapore law also, let's presume that they become resident, domestic tax law. So there is a dual residency. Under Indian law, because of 60 days, they are resident of India. Under Singapore law, because their stay has exceeded 182 days. Let's presume that 180 days is the criteria. Then they become resident under domestic law of both the countries. So there is a situation which has to be resolved, and therefore treaty under Article 4 gives a set of rules, and this has to be applied in the hierarchy. So one will have to read every treaties. So first criteria is permanent home. Second is even permanent home includes even the whether you have a rented premises or own premises, that does not matter so long as you are staying in that house. Center of vital interest includes family, personal and economic interest, etc. Then habitual abode, so where you are over a period of time staying more, whether it has to be seen in a 1 year, your residential, no, that does not determine habitual abode. So over a period of time where you are staying for a longer period, and their purpose for which we are saying is irrelevant. Then if this three tests fail, then the fourth is the nationality. Even if you are national of both the countries, it will again fail. Then both competent authorities of the both the countries will have to resolve dual residency issue and determine the residential status of one of the countries. So DTAA does not determine the residential status, it only resolves dual residency issues. That's what. Earlier there were judgments, M.A. Rafiq, Radhikant Bhatt, many of them have become irrelevant in the sense that domestic law defines liable to tax, which was not the case when those decisions were delivered. And therefore, one will have to keep in mind the meaning of liable to tax. In case of M.A. Rafiq, etc., Radhikant Bhatt, it was decided, it was a case of a resident of UAE, and he was not paying any tax. So under domestic law, the department treated him as a resident and they denied the treaty benefits. So liable to tax was interpreted as if the tax liability was imposed at all by the UAE authorities on individual, whether he would be liable to tax. So they said liable to tax means potential liability is also included in that case. But Subsequent to the insertion of liable to tax in domestic law, it has been prescribed that liable to tax means actual payment of the tax, and therefore these decisions will not be helpful, and you'll have to see where he is actually paying the tax. If he is liable to tax as a resident, then only that criteria will be helpful. Yeah, proceed, Ujwal.
So this is just a pictorial presentation of what we discussed. Think, and this is one example of treaty which we have taken, which is India-UK DTAA. So as we discussed, Article 4.1 gives the criteria and the hierarchy. See, tie-breaking test is under Article 4.2, where it determines the tie-breaking rule based on availability of permanent home, center of vital interest, habitual abode, nationality, and if these criteria also do not fit, then you need to go under MAP, which both the countries will sit together and then decide in whose favor the tie breaks. So if for practical example, if I may give, say, in between, Priyanka Chopra had moved out of India and got married. So when we see want to determine a residential status, see what will happen, what is the availability of permanent home. So if she is married outside India, but she has her maternal home in India also. So the permanent home is available at both places. In such case, where do we go? Then we go to the next criteria, which is center of vital interest, where the social and economic relations are. So she has economic relations both in India, as earnings were in India also, and there were earnings abroad also. So here again, we are not able to determine the status. Then we move to habitual abode. See where the person generally stays. See if in this criteria, if the person used to stay in both equally, say 180 days in India, 180 days abroad, then again it would shift to nationality. Say for example, a person has Indian nationality, Indian passport also, and say a UK passport also, for example. Then finally, this would go to MAP of both countries to determine the status. Let us take an example of tie-breaking rule. Say an outbound individual migrating to UK on 31st October. He moved to UK on 31st October. Say take example of Virat Kohli and Anushka Sharma, which recently moved to UK. So if they move to UK on 31st October 2024, what would be the residential status in India and residential status outside India? So for the period April to October, status would be resident and ordinarily resident because they were in India for more than 182 days. Status in UK would be of a non-resident, and therefore tiebreaker doesn't apply. So in India, all the income becomes taxable, and UK it is not taxable. For period 1st November 2024 to 31st March 2025, he would be a resident and ordinarily resident if he was in India for more than 182 days. Presume that he also becomes a resident of UK under the domestic law. Say if UK had a criteria of 100 days only, then he would also become a resident in UK. In such a case, he would go as per the criteria mentioned in the previous slides. So if the tie breaks in favor of India, then foreign income would also be taxed in India. However, if tie breaks in favor of UK, foreign income in India would be exempt. However, the income in UK would be taxable. So this is the importance of determining the residential status.
So this is a case of a split residency. See, the tie breaking we, as I mentioned, you will go only if you are under the domestic law of both the countries, you are resident. So India also, because he was in India for 182 days. So Virat Kohli in this example, he was in India for 182 days and therefore is resident of India. In UK also, he say UK gives a criteria of 60 days, let's presume. And therefore is also resident of UK for that particular year. And therefore it is a dual residency. So when you apply tie breaking, there could be a issue and sometimes a split residency may arise. So in this particular event, if you apply this test, then up to a particular period, you are resident of India. And because he is going for the first time, and therefore he is an ordinary resident, in that event, he will be uh, able to take, for first period, April to October, he will be paying tax in India. However, he will not be paying tax in Indian income in UK because he is a non-resident under the treaty for that period. The subsequent period, though is R but OR, right? But tie breaks in favor of, if tie breaks in favor of India, then even his foreign income in UK also. So as for domestic law, if he's not treated as a resident of UK, then even if he has paid tax in UK for his foreign income, that income will be included. Being not ordinary resident, income will be included in his Indian income. But if tie breaks in favor of UK, then UK income will be exempt because he will not be paying any tax because under treaty is a non-resident and therefore is not liable to offer his foreign income in India, and he will be paying only tax on his Indian. As a non-resident also, he has to pay the tax on his Indian income and therefore he will be paying tax on his Indian income in India. Right. Yeah.
Yeah. So I think we have covered a lot of. Should we cover this? In interest of time, we move.
You can move further. Yeah.
These are the few case studies which we had taken.
An answer is also given in case study 3.
Answer is
So
also
you can,
given.
yeah, you can move.
And it also answers one of the questions raised whether Schedule FA and would be applicable. So we have included the same here.
So Schedule FA is not applicable if you are R but NOR. There is a question by Biraj Kotecha. So
that
answer
we
is
have already
for R but
covered.
NOR not applicable.
Yes, in the earlier slides of benefits. Yes. Part 4, tax incidence for non-residents under different heads of income. So in India, the various heads of income are covered under Section 9, which are either business income, salaries, dividend, interest, royalty, or FTS. These are the main heads of income in case of non-resident and NRIs.
Apart from the income from house property, capital gains, etc., are also there. Yeah.
Yes, but these are the main heads where generally non-residents would be taxable apart from regular income. So business income from a business would include income from a business connection in India or through or from any property or capital asset or in source of income or transfer of capital asset situated in India. Business connection would also include significant economic presence. So this was also a definition inserted by the Finance Act 2021, which came into effect from that year, which we will cover in the subsequent slides. Salaries for services rendered in India are taxable. Salaries by government for services rendered outside India. Dividend paid by an Indian company. Such income are deemed to accrue or arise in India for non-residents. Interest by government or by a resident. Royalty by the government or a resident. And fees for technical services given by a government or non-resident. All these incomes are taxable. What do you mean by business connection? Business connection means income deemed to accrue or arise in India, and income can be accrued either directly or indirectly, or through either of the sources. Like a business connection in India includes significant economic presence or income from a property or asset situated in India, or transfer of capital asset situated in India. So all must be aware of the famous Vodafone case. So even if two non-residents uh, purchase or sale any, purchase any business, however, if the assets are located in India, the income is deemed to accrue or arise in India. And same is the case for the transfer of a capital asset situated in India. What do you mean by business connection? In case of a non-resident carries business in India or has given any authority to resident to conclude contracts on his behalf or to play a principal role in concluding the contracts, or he maintains in India stock of goods or merchandise, regularly delivers such goods or merchandise on behalf of non-resident, or secures order in India mainly or wholly for the non-resident, then such person will construe a business connection of the non-resident in India. So basically, say even if a non-resident appoints a person in India to carry on his business, uh, maintain stock, so such uh, activity would constitute a business connection, which again would become liable to tax in India. So as per the case of Supreme Court in CIT versus RD Agarwal, it was held that business connection may include carrying on part of the non-resident through an agent, or it may merely be in relation to between the business of non-resident and activity of the agent, which facilitates in carrying out such business. So even if a person who helps a non-resident in carrying out such activities would also form a business connection. So in such cases, a portion of the income which actually arises to the non-resident through this business connection would be deemed to accrue arise in India as is reasonably attributable to the operations carried out in India. Say if a person is selling goods of say 100 rupees in India, there are certain part of such activities uh, uh, of this income accrues in India, and such income needs to be attributed, and this attribution basically dealt with by the transfer pricing operation laws in India. And operations in India could include income from advertisements or sale of data collected from resident or from a person who uses address located in India, and sale of goods or services using such data collected from a resident for the purpose he uses protocol located in India. What does business connection not include? Any business carried out by an agent of an independent status acting in an ordinary course of business. So if a non-resident has appointed an independent agent to carry out such activities, say that agent is operating for say 10 non-residents and he is independent, then it would not constitute a business connection. Or occasional activity, say when a non-resident comes to India and occasionally brings certain goods for sale, then it would not be constitute as a business connection. Or purchase of goods merely for the purpose of export. If he purchases certain goods only for the purpose of export, it would again not constitute a business connection. Examples of activities which do not constitute business connection. There are certain exceptions given under the Act, that a broker or general commission agent or independent agent carrying out a business acting in the ordinary course of business would not constitute a business connection. A business of which all operations are not carried out in India. The business deemed to accrue or arise in India shall be limited only such part as is reasonably attributed, as we have discussed. So there are few exceptions like collection of news and views in India for transmission outside India. There are various news agencies operating in India like CNN, BBC. For them, such exemption is given that these activities do not constitute a business connection and thereby they are not taxable. Or shooting of cinematic films in India, if such non-resident is individual and who is not a citizen of India. So for specifically for non-residents shooting a film in India, uh, and the condition or criteria is that they should not have any partner who is Indian citizen or who is resident in India, or a company should not have a shareholder who is Indian citizen. So this is just for promoting shooting of foreign films in India. Such exception is given. And in case of a foreign company engaged in business of mining of diamonds, from the activities which are confined to display of uncut and unassorted diamonds in a SEZ. For example, Bharat Diamond Bourse is defined as an SEZ. So such activities specifically exempted from not being business connection, and therefore these activities would not be liable to tax in India.
So basically, business connection is important for export of goods and services by non-residents, and therefore whether they have any connection in India. So these are the various examples, and the domestic law we have given reference to various sections, explanations, as well as under treaty. This concept is known as a permanent establishment. So under domestic law, it is known as business connection, and the provisions are contained in section 911. Whereas under treaty, if you go, you will go by permanent establishment under Article 5. So if there is a business connection, that means even if you are a non-resident, some income is coming to you for export of goods or services from the foreign country, and whether there is some activity happening in India. Business connection means while you are exporting few things to India, some activity is happening in India, like permanent establishment. So some activity is happening in India, then it is taxable. So many times people keep on asking questions that when we remit this amount abroad, whether we have to deduct tax, that this is in the nature of business income. And therefore, under domestic law, you have to see whether there is a business connection. So when you are, say, for example, taking a conclusion that there is no business connection, then under domestic law itself, that business income is not taxable. So you have to take a declaration also from non-resident that I do not have a business connection in India. But when you go to a treaty, the concept of permanent establishment comes in, which is at times liberal than the 911. So even if you are taxable under 911, you may escape under Article 5. So if you have to go to treaty, you have to take a no permanent establishment declaration from the party. There is no permanent establishment in India. Further, mere declaration is not helpful. You have to examine certain facts. These are various facts. So similarly, you examine the criteria given under the Article 5 of the treaty. That factually, if you are aware of certain information which leads you to believe that the declaration is wrong, and you merely cannot rely on, say, a foreign company has a branch office in India. That entity is giving you a declaration that I do not have a business connection or I do not have a permit establishment. That is a wrong declaration. So a professional has to examine before taking a view, because many times you come across situations where you have to issue 15C and CB forms, and therefore in that event you have to examine whether there is a business connection. If you're examining under domestic law, if you can rule out under 911, no need to go to treaty. But if you are not able to rule out, you go to the treaty. But TRC with Form 10F along with no P declaration is must. Usually you'll have to move little faster because of the
Yes,
paucity of time. Yeah, move further.
yes,
Yeah. So business connection, if there are examples, you can skip.
Yeah. No, but as discussed, this was a very important definition, because most of the questions people ask, as he mentioned, whether the income payment which we make to non-resident becomes taxable. So we need to see this definition and thereby then conclude whether we need to deduct appropriate taxes before making payment to non-resident. Property, asset, or source of income. This, I think everyone is aware, whatever income which we earn through property is taxable in India. It would be either sale of property or income earned via rent or indirect transfer of assets, like we said, the Vodafone case, where even if two non-residents deal, uh, buy shares, but the main substantial value is derived from Indian assets, it would still become taxable. And significant economic presence, this is an important aspect which had come into consideration in the last 3-4 years. Significant economic presence of a non-resident shall also constitute a business connection. So this is a deeming provision. Significant economic presence shall mean transaction in respect of goods, services, or properties carried out by a non-resident with any person in India, including provision of download of data or software in India, if aggregate payments arising from such transactions during the previous year exceed the prescribed limit, which is 2 crore currently, or a systematic and continuous soliciting of business activities or engaging in interaction with number of users in India. Presently, the limit is 3 lakh users. So in such case, transactions or activities which are confined to purchase of goods in India for export shall not constitute a recipe. This is a exception given. And again, only the portion of income attributable would be liable to tax. So many companies, were selling softwares in India without having server in India and directly on the website. So it is intended to cover such companies as a deeming significant economic presence and thereby having a business connection. So importance of this definition and the categories of non-resident that would be impacted due to the significant economic provisions. Non-residents from countries that do not have tax treaties with India. So as mentioned by Natwar Thakrar, he was saying that even if under DTAA you may not be permanent resident, you do not have a permanent establishment, you may get out uh, of the definition of business connection. However, this definition will impact non-residents from countries that do not have tax treaty with India and non-resident from countries that have entered into tax treaty but they fail to provide TRC. In many countries, it is not easy to get the TRC or it takes a lot of time. So such persons would also get impacted. And what are the transactions covered? Sale or purchase of goods, services, or property through digital means. Any transaction involving download of data like in-app purchases, provision of online gaming, provision of services of streaming, audio, video content, interaction with customers, and websites, cloud storage, computing services with significant user database in India. Such companies would get covered under this definition, having business connection. What are the salaries? Definition of salary. Salary means income earned in India, and salary due or paid for services rendered in India. Payment for leave period also is to be considered, that is preceded or succeeded. Actual payment or place of payment is immaterial. Salary payable to a citizen of India who is a government employee for services outside India is also taxable in India. Physical presence is a determinative criteria for service, so he has to be physically present. However, there are few short stay exemptions given under Income Tax Act. Say if employment is only for less than 60 days or 30 days as provided, then such salary income will not be taxable in India. We also need to see Article 15 and Article 19 of the tax treaties for determining the taxability of salaries. These are a few judgments for where litigation had happened. So I will move forward because salary is more or less settled. What do you mean by employment outside India? Employment outside India would mean a case where the employee is posted outside India either temporarily or a long period, and would not include the case of an employee who has gone abroad for a few days. So, and we have taken various judgments to say what would mean employment outside India, whether it would be taxable in India or outside India. Taxation of DTAA. Generally, the right to tax is given in the country where the individual is resident, provided that the individual has rendered services in that country only. Salary received in India by a non-resident for rendering services abroad can be claimed exempt in India if the following conditions are satisfied. The individual is non-resident in India under the DTAA and resident of the other country as per a DTAA. So as per the earlier definition, he had said salary could be taxed in India even though it is received in India, even if it is received in India, though it was earned outside India. However, if we satisfy the following conditions, even if the salary was received in India, though not earned in India, could become exempt. The criteria given here are individual is a non-resident in India and under the DTAA and a resident of that country as per the DTAA. An individual exercises employment in the overseas country and pays taxes in that country, and the TRC is obtained from the overseas authorities. Taxation of salary under DTAA. Let's take this example. Mr. A citizen of India, is sent on secondment to Australia from 1st May 2024. He rendered his services outside India, that is in Australia. However, he receives his salary in India. He is a non-resident of India and a tax resident of Australia. Whether this salary received in India is still taxable, because these are practical case studies, where only husband shifts outside India, but the full family is in India. So many times the employees do request to credit the salary in Indian account. So what would be the answer in such case? The salary income earned by Mr. A, who is a non-resident in India, in relation to services rendered outside India, is exempt under Article 15 of the India-Australia DTAA, even though his salary is received in India, if the following conditions are satisfied, that is, he must be a non-resident under DTAA, he must be exercising employment in Australia, and he must pay taxes there, and he must provide a TRC from the Australian tax authorities. Income from house property, like everyone is aware, the income by earning rent, this is taxable in India irrespective of the residential status. Dividend, interest, royalty, and fees for technical services. Special rates of taxes are provided to non-residents under Section 115A. say for interest on monies borrowed by Indian company, it would be taxed at 20% plus cess, plus surcharge. Most important, dividend, 20% flat rate is provided irrespective of which tax slab you fall. Royalty income is taxable at 10%. These are all.
You can skip Ujwal this side. You can move.
Yes.
Yeah, these rates people can see. Yeah.
So this again can be skipped. These are
You can skip this.
normal provisions applicable.
So treaty, there is a special rate for this interest, dividend, and royalty. There are special rates. So it is a splitting of tax revenue. So in the source country, wherever there is a source, and the resident country, the concessional rate is given. So source country only can levy concessional rate of tax. The resident country will levy full tax, but whatever tax is paid in the source jurisdiction, they will give the credit. They will not give the refund. If higher tax is paid, say Dubai resident gets some royalty from India, and India taxes at say at the rate of 10%. So that is a tax paid in India. Now in Dubai there is no tax, so Dubai government will not give a refund. So whichever is the higher tax, that will be applicable. But if there is a differential tax payable in the home country, they will have to pay the differential tax. So this is so the resident state gets a right, and the source country also will source country gets a right, and resident country also will levy the tax on that. So this also you can skip Ujwal, this example. Otherwise, there is a sort of time. We will save so a lot of questions are there on the presentation. So MCTC and LMP, they can share this presentation with the participants. Same is the case with interest, Ujwal. You can skip this example also.
Capital gains. So let me cover this because there were few questions on this. The normal capital gain provisions for short term, everyone is aware. The tax rates were increased from 15 to 20%. No minimum threshold exemption is provided. In case of taxation of long-term capital gains, there is exemption provided up to 1.25 lakhs. However, the rate, after 23rd July, the rate was increased from 10% to 12.5%, and on the tax computed without indexation benefit. So in case of non-residents, the indexation benefit option is not available, unlike in case of residents, where you still have the option to choose between say 20% with with indexation or 10% without indexation. However, this benefit is not available, and it will be taxed flat at the rate of 12.5%. What is the importance of TRC? So ideally, this we have covered in our presentations, at each and every level. To prove your residential status and to claim treaty benefits, TRC is a must. Also, Form 10F has to be filed online, which is now online, unlike the manual form which used to be done earlier. So what is the interplay between 206AA and TRC? So if PAN is available and TRC is available, the rate we can take as per the DTAA. If PAN is available, TRC not available, then we need to take the taxability as per the Income Tax Act. If PAN is not available and TRC is available, then we can still take DTAA benefits. If both are not available, the maximum rate of TDS is 20%. There are few case laws where they mention that TRC is must for claiming the treaty benefits. This slide also covers the importance of TRC.
So this 195, which you can skip 195 because there are a lot of questions. So I would recommend that instead of taking 195, you take up the questions. Whatever you're
195
dealt with, you
people.
can skip. Otherwise, you can go. Yeah, the procedure for TDS also is given. So those who want to apply, they sell property. There are provisions for 195 and 197 application. So that procedure is also given in the presentation. So just go on. Okay, go. Go to the next slide. Yeah, this is the process through which you can file the application. That is procedure is also given. Go further.
Yeah, so with this we
FAQs,
would
yeah.
officially
So
end
Ujwal,
the
instead of taking this
presentation.
FAQ, would you like to take up the actual questions?
No, we have time, so we can take FAQs or we directly move to question.
No, we can take FAQs.
Okay. So these basically are questions which we have pointed out, which people generally, want to know. So I would ask you questions to Mr. Natwar Thakrar. What are the benefits of OCI card?
See, OCI is Overseas Citizen of India, is a card where earlier there was a PIO card, Person of Indian Origin, that has been replaced with OCI card. The OCI card is just like a green card. It gives you a right to visit India without your getting the visa. But apart from that, they've made it mandatory for few things that has to be kept in mind. If somebody wants to, other than the opening a bank account in India, OCI for bank account opening or bank fixed deposit, OCI card is not mandatory. Other than that, if you want to set up a partnership firm in India, or you want to say buy a property in India, etc. So various things you want to do in India, OCI card is must. If you are a foreign citizen, if you do not hold an OCI card, you cannot buy an immovable property in India. You cannot invest in stock market in India. You you may be able to open a bank account. You may not be able to become a partner in India. So that has to be kept in mind that OCI is mandatory for various other things apart from the traveling purposes.
Yes. So for non-resident, is it compulsory to open DMAT linked to PIS account only? And PIS should be linked to NRE only, or NRO also is okay?
Yeah. So under FEMA earlier, there were two schemes, both repatriable and non-repatriable. They were giving a PIS scheme for non-repatriable account also, and there was a PIS scheme for repatriable investment also. So when you open a DMAT account on repatriable DMAT account as a non-resident, you could open two PIS account. One is NRO and one was NRE. But in recent amendments in FEMA, they have done away with non-repatriation basis. However, banks practically do keep PIS because they have to keep a track. If they sell shares, bank is under an obligation to withhold the taxes on capital gains. And therefore, what bank do, that even though the provision is not there under the FEMA, practically bank do keep track of your investments, which is happening through your NRO account. And for internal purposes, they keep the same tracking mechanism as that of a PIS. But that does not mean, so there are people who have a ordinary account in India, they are dealing with like a ordinary residents in India. So to deal through an ordinary account is a violation of FEMA. But if you have an NRO account and you are directly dealing with that account and bank is not asking you any questions, then bank may be failing in tax withholding obligations. Because if bank does not know your cost, how do bank will withhold, determine the capital gains, and therefore bank, then in that event, if particular bank is not maintaining PIS, every time they will request for the calculation of the computation of capital gains and the tax liability, and may insist on 15 CSCB or a certificate from a chartered accountant before crediting the amount to NRO account. So practically most of the banks do keep PIS account both for NRE and NRO accounts.
Third question we have already covered, which is the main indexation benefit available. Fourth point is whether non-resident is required to file ITR even if full taxes are deducted.
Yeah. So earlier there were exemption only under 115G. There was one section that if you are going by chapter 12A, if you are covered by chapter 12A, but there you have to exercise the option in writing. But apart from that, few years back, they have made an amendment under 115A of the Act also, where if there are certain incomes which are in the nature of interest, dividend, royalty, and on which tax is deducted as per the domestic tax law, not you have not taken any treaty benefit, then in such case, when you payment is in the nature of say royalty or FTS, and tax is paid as per the domestic law, then you are exempted from filing the tax return. Except for that, if you obtain any tax treaty benefit and not paid tax, or tax is deducted at the rates prescribed, lower rate prescribed under the treaty, then it is mandatory for you to file the tax return.
Okay. Are any number of limits on the number of properties an NRI can buy?
Yeah. So this is the issue under FEMA. NRI can buy for the purpose of investment. There is no restriction on purchase of the commercial or residential property. NRI cannot buy a agricultural land, plantation or farmhouse. So NRI cannot buy a farmhouse or it cannot buy agricultural land. But buying number of properties for the purpose of investment, he has to demonstrate that he is an investor, is not a restriction. However, repatriation is limited to two such properties during his lifetime. So he can maximum remit amount up to 2 properties, and thereafter, if he wants to remit every year, he has a limit of $1 million. So within $1 million, he can remit outside India. And this investment, the number of properties should not look like that is trading in real estate. So trading in real estate, that means speculating in real estate. If it does on a very large scale, then it could attract, and a view can be taken that is trading in real estate, which is a prohibited activity.
Can an Indian person take loan from NRI relative?
Yeah, this is again after notification number 3 and 4 were replaced by 3R, where earlier there were provisions where there was a direct approval by RBI to borrow from non-residents, and there was no restriction of borrowing from the relatives. But under the new scheme, RBI said that you can borrow from a relative, but under the scheme to be framed by RBI. The RBI has not framed any scheme. While there is a provision, but there is no scheme framed, and therefore non-resident can borrow from a close relative only with the prior approval of the Reserve Bank of India. So you have to move an application through AD Bank that you want to borrow along with the agreement, and bank will seek, or RBI has delegated certain powers to the bank. So bank may be in a position to also verify the facts, and on the basis of the delegated power, bank can grant you an approval on behalf of the Reserve Bank of India, and then only you can borrow. But if you don't take any approval, then it will be a FEMA violation.
So are foreign assets required to be disclosed in Indian ITR for Schedule AL if income exceeds 1 crore?
See, NRI does not have to disclose any foreign assets, neither R but NOR. So under FEMA, if under Income Tax Act, if you are non-resident or R but NOR, then you are not required to disclose any foreign assets. You do not have to fill in schedule. The AL is you have to disclose. See, assets and liabilities in India, you have to, if your income exceeds 50 lakhs, then assets and liabilities in India you have to fill in any case.
Yes, Indian
But
assets are required.
Indian
but
assets are
foreign
required to be
assets
disclosed if your income exceeds 50 lakhs.
No, the
Like-
limit has increased to 1 crore.
1 crore, yeah. So then they are required to declare Indian assets.
What is the limit by NRI on sending money abroad?
NRI is a $1 million scheme. If, so whatever money that is lying in his NRO account, NRE account is freely repatriable. But if there's any money lying in NRO account, he has to prove the source, and he has to also prove that he has paid taxes on that. So many times people come to chartered accountants. So chartered accountants should see before he certifies that the whatever money lying in the NRO account, what is the source, whether he has paid the taxes on that. Thereafter, he can certify that there is a surplus money on which taxes have already been paid. That is that remittance certificate is under FEMA. There is no, because it's not in the nature of income. So it is not prescribed under Income Tax Act, but for FEMA purposes, the banks accept same 15 CSCB format. So it is the obligation of the person who is certifying to see that whatever money that is lying, every penny that is lying in NRO account, there is a tax liability has already been discharged.
Does Black Money and PMLA Act apply to NRI and OCI?
If they are person non-resident in India, then obviously for because it is a tax on foreign income and assets. So when they are a non-resident, that whatever that you've done subsequent to your becoming non-resident, this provision will not apply. But while you are resident in India and if you have committed any violations, then in respect of those years, obviously the provisions will apply.
Are there any things to be kept in mind if NRI has a joint account with resident?
So NRI, the resident is allowed on former or survivor basis. So he cannot be a joint account holder, either or survivor basis. So when a resident is allowed to, a non-resident allowed to jointly open the account with close relatives, resident relatives, it has to be on former or survivor basis and not on either or survivor basis. So that has to be kept in mind. Otherwise, the account can be opened.
If non-resident wants to form an entity for business in India, what are the things to be kept in mind?
So non-resident, see, one is there are two schemes under FEMA. One is for foreign direct investment, where it is repatriable. Then all the rules and regulations for FDI is applicable when you invest on repatriation basis. But when you want to invest on non-repatriation basis, which is available only to our Indian citizens or OCIs, when they invest on non-repatriation basis, then they get certain exemptions from FEMA compliance. So a lot of FEMA compliances has to be have been waived off. So if you invest in India on non-repatriation, no reporting is to RBI, no forms are to be filed, and everything is given. Just as a consultant, we have to tell them that you please have the OCI card. If you don't have OCI card, you will be committing the violations. If you are investing on repatriation basis, you have to comply with everything. You are just like a foreigner, and all the laws will apply to you.
Can a person choose to pay tax on withdrawal basis for foreign retirement account?
Yeah. So there is a foreign retirement account. There are conditions. Section 89A of the Income Tax Act, and there are certain forms are to be filed. The provision has been introduced just few years back that if you open a retirement account like pension plans overseas, so that retirement account should have been opened while you are a non-resident. The contribution that you have made to that account is also while you are a non-resident. If these two conditions are fulfilled, then it is applicable to specified countries again. So currently, USA and UK are the two countries which are specified countries. And if you have a retirement account in those two countries, then Section 89A gives you an option that if you are paying tax in those countries on withdrawal basis, then in India also you can opt to pay taxes on withdrawal basis on those retirement account. Otherwise, whatever income that accrues as a resident and ordinary resident, you will have to pay taxes. So if retirement account you are getting interest or dividend or anything, then you will have to pay taxes on those accounts in India. Yeah.
And the last two questions are, can they continue with PPF account in India or they need to close, and whether they can hold the Aadhaar or need to surrender?
Yeah. So NRI can continue to hold PPF account. There is no need to close it, but they cannot make further contribution except that is minimum 500 rupees that is required they can make, except that they cannot make any further contribution. As regard Aadhaar, etc., they already obtained while they were entitled. Then they can continue to hold, and in fact, it is mandatory then if they hold it to link it with their permanent account number.
Okay, so with this we have officially completed our presentation.
There are a lot of questions, Ujwal.
There are a lot of questions.
Just look at those questions.
Which we can take up.
You want me to take up, Ujwal?
No, I will read through.
Okay.
Or
so no, I can read through. So in case anyone has any questions, you said, for selling land and building resident property in India are free long-term tax rate 20% with indexation benefits. Yes, if it is prior to the amendment, they've given a date. Prior to that, you can get indexation benefit or that foreign, and but subsequent to that, that indexation benefit has been withdrawn.
I will take the questions. If person stays in foreign country for 7 months for medical treatment, what will be the residential status?
And if you go out of India, then for purpose other than employment or business, you are hit by 60 days conditions, and therefore you stay for say 7, 8, 9 months. Still, you will be a resident.
Capital gain income from redemption of mutual fund by NRI residing at UAE is say 25 lakhs for financial year 24-25. His income exceeding 15 lakh, he is deemed to be resident. His stay in India is less than 120 days. Question is whether such income from mutual fund gains, whether equity or debt, would be taxable or exempt based on DTAA.
Yeah. So if you are entitled to DTAA benefits and any particular income, in this case a mutual fund, because in UAE is a specific case, and so many treaties they cover shares, but they don't talk about mutual funds, and therefore it is taxed in the country of residence. So that is under treaty. If that particular income is exempt, it is not to be counted. When it talks about income, as for the computation of income, whatever is chargeable, that you have to count and exempt. So many non-residents have only FCNR and NRE accounts in India. That income is not taxable at all in India. In that event, that 15 lakhs, it has to be counted from the purpose of taxability under the Income Tax Act. And exempt income did not be considered, either under the Act or under the DTAA.
US resident earning income from social media while he stays in India for 200 days. Whether he would be...
So when he is in India for 200 days, he is a resident of India. But from the facts, it cannot be determined whether R but NOR. So suppose he has stayed for 200 days for the first time, but otherwise he was always non-resident, he could be NOR. So if it is NOR, foreign income may escape except business control from India. Otherwise, if his ordinary resident, his worldwide income will be taxed in India.
And this very practical question is mandatory to tax dividend under 115A, or we can tax it under the normal slab rates? This is because generally, if a non-resident only has say 1 lakh of dividend income, and if we offer it under 115A, it does not give us a basic exemption limit of 2,50,000. So is it mandatory to offer under 115A, or should we offer under the normal slab rate?
Yeah, this is an irony because if you look at the provisions, the non-residents, they don't get basic exemption as far as the capital gains are concerned. If you look at 111, 112, it only says that basic exemption is not available for capital gains, but for that basic exemption is available. By putting the dividend, if the dividend exceeds basic exemption limit, then it will be taxed at the special rate. So if it is below the basic exemption limit, you did not put it under the special rate, because the moment you put under the special rate, even your income is below basic exemption, it will calculate the tax the way the softwares are designed. So probably the representation is required that under the provision of the Act, when basic exemption is available only, not available only for capital gains, but by putting this into the special rate. And when we fill in this, many softwares insist that since your status is non-resident, you should put it under the special rate. But my view is that your income is below the minimum income chargeable to tax, then there is no need to put it under the special rate. Only when it exceeds chargeability, then only you have to put that income under the special rate. That's my personal view, but the softwares do give you the warnings every time that you fill in. But that practically you have to take a stand by referring to 111 and 112, 112A.
Can NRI borrow from resident Indian?
So residents are not allowed. So resident Indians, if you look at LRS, so LRS, there is apparently it seems that you cannot give a loan except to the close relatives. So you can give under LRS to close relatives, and it could be subject to 20% TCS also. So if you are comfortable with that, then you can look at LRS, and under LRS, but for LRS, you cannot do.
Oh, and I think there's one final question. NRI has legally inherited the property from his mother in 93 and sold the property in 25. What shall be the indexation? So I think indexation is not available uh, except for the 2001 value.
No, so if it is sold before the date, prescribed date in the Finance Act, then
Oh.
indexation benefit will be available. Now, what will be the indexation? The period of holding will go back to the date of ownership will go back to the date of the previous owner. There were controversies in between that now, say, suppose you inherited just 2 years back, while mother was holding it 20, 30 years back. So whether you can go from 2001 and get the indexation benefit or from the period of holding, there were controversies. My view is that you can go back to the original period of holding by the parents, 2001, or fair market value as on 1/4/2001. And if you are entitled to indexation benefit, if you are not entitled to the indexation benefit, then this fair valuation replacement, whether you are entitled or not, there are two views again. That fair valuation is only for the purpose of indexation as on 1/4/2001. And when you are not entitled to the indexation benefit, whether you can replace the cost with the fair value as on 1/4/2001, that is the issue, because the indexation benefit is now restricted to resident only, the inflation, because they are suffering within the country. And the view seems to be that you are not entitled to any inflation because you are not part of the Indian economy, and that inflation does not apply to you. So if it is linked to the indexation benefit, I believe you may not be able to take the even fair value as on 1/4/2001, and you have to go back to the original cost.
How POEM will apply in India under FEMA and IT Act?
See, POEM is a place of effective management. Under FEMA, there is no concept like POEM. FEMA, it is under the income tax only. So if you are controlling that entity under India, place of effective management. So you have to, it is a state, it's a fact. So there are factors outside India, factors in India. You have to take a balanced view. Some factors may, you have an office, you have a staff, your critical decisions are being taken abroad. That is some factors in your favor. But if you do not have an office outside India, you do not have a staff in India, the person who is sitting in India is taking various decisions, and even critical decisions are being taken while sitting by a person resident in India, then probably POEM could lead into India. The government of India has come out with a guidelines, POEM, where they have bifurcated this into active business and non-active business. So one will have to go by that POEM criteria. Currently, it is not applicable for income up to, receipts up to 50 crores. But those circulars, etc., they are for the earlier act. We'll have to see even the validity of the circulars under the new act, and also see what are the provisions under the new act. So whatever discussions we have done today, it could be a history if there are major changes. But probably when we went through the provisions, more or less identical provisions are there under the domestic law. But does that mean those circulars which are issued under an act which is already repealed will continue to apply under the new law? Probably government will have to reconsider. So one will have to wait for what kind of circulars we are getting, including the circular that is on POEM, whether that limit of 50 crores stays or it has been withdrawn, that one will have to see. And therefore, it becomes very important under the new law that your affairs have to be planned in a manner so that you are not hit by POEM and you may not get the benefit of that circular any longer. It was only a provisional because the POEM was meant that already those who have already created entities outside India and they continue to control from India, it was a small window given to the people by issuing that circular, and it was never a permanent feature. So one will have to wait and see what is the situation under the new law. So I think yesterday only the president has given the assent. So people who have businesses set up outside India have to be extremely careful, and they should not merely look at 50 crores turnover, but they will have to put their house in order. Otherwise, they will be subjected to tax in India.
So, one question, final question was, can we avoid TDS on redemption of mutual funds? So, I think he's talking from the point of view of Dubai, where it is exempt.
Yeah.
But I think
Yes,
there is,
you have to provide. See, when you go for redemption, if the mutual fund is ready to accept your TRC with the 10F, they have to give an option. But most of the mutual funds are not aware. But one will have to take up with the authorities who are withholding the taxes. So practically, they are entitled, but practically, how far it is feasible, one will have to see. Again, a representation can be made in this regard that in most of the treaties provide that mutual funds are not taxable. A mechanism, if it is not available, one will have to make a representation to mutual funds. It's not an issue with the government. It's an issue with the mutual fund that they should open a window. In many cases, corporates for dividend are accepting your non-residential status, your treaty benefits. So same thing should apply to the capital gains also. But it's a practical issue and not a legal issue.
yes. So, I think we are done with all the questions.
Back
Over
to
to you,
the
Nikhil.
organizers.
I think we have one last
Thank
question
you.
from Adarsh Bhai. If we can just, I think you can answer it quickly. Taxes paid abroad, credit available in India, taxes paid on calendar basis, how to take the credit of Jan to March month.
Yeah. See, normally there is no provision in India that you take when foreign country you have a calendar basis, you have to follow the calendar basis. But if you are following consistency, then various courts have taken the view that once you are doing consistency, that principle should apply. But ideally, you will have to recompute. So for tax purposes, you are going on the basis of the calendar year. But for Indian tax purposes, you will have to compute from April to March. And based on that, whatever taxes that you are paid or you are liable to pay in those foreign countries, you should claim and file
Okay.
Form 67A along with some calculation. And by the time that matters comes up, probably you would have already filed taxes for the balance 3 months or whatever period, or 6 months
Correct.
period or 9 months period, whatever in the other jurisdiction. Generally, it is for 3 months. You are taking calendar month. We are excluding 3 months, adding 3 months. So by that time,
Correct.
probably you would have filed the return. And if you do it on a very proportionate basis and attach along with your Form 67A,
Form
we
60.
have seen that nowadays even CPC is easily giving you the credit for the taxes paid. Sometimes they do ask about the actual kind of a things. But if you do it on calendar basis, CPC does not know. You attach the documents and either to the, you have seen in many cases that they have been considering and they are giving, they have never raised the issue. But technically, law does not give you an option, but practically sometimes it is happening.
Okay. Over to Zankana, please.
Thank you. Thank you, Natwar bhai and Ujwal bhai. Thank you for the insightful session for today's session. And now, if there are any further queries from our audience, we would request them to email us. We will share the email ID in the chat box and will be shared on the WhatsApp group also. So now would request CA Nidhi Thakrar to give vote of thanks to our today's speaker. Over to you, Nidhi.
Good evening, everyone. Hello. Yes. On behalf of the Malad Chamber of Tax Consultants and Sri Lohana Mahaparishad, I take this opportunity to extend our heartfelt gratitude to our distinguished speakers today and also the father and son duo, who truly made this session on NRI taxation a memorable learning experience. They explained the subject in the most practical way, showing how a residential status can be differently seen under FEMA and Income Tax Act. All the practical life scenarios being covered. For example, when a person goes abroad for higher education or someone simply accompanies their spouses overseas with respect to what are the tax treatments and what are the FEMA rules. Through such simple yet relatable examples, they made complex provisions easy to understand. The session also covered country-wise examples, deeming provisions, issues of citizenship, relevant case laws, and even the tie-breaking rules under DTAA. all explained with clarity. The speaker Ujwal sir playing a dual role of explaining the provisions as well as taking up the questions to Chairman Natwar sir on behalf of the participants. We also deeply appreciate the Chairman Natwar sir's impromptu interventions, be it elaborating on a fine point of law, sharing his vast experience to explain the provisions, or encouraging the participants' questions. It added great depth and ensured this was not just a lecture, but a highly engaging conversation. To our participants, thank you for your active involvement. Your thoughtful questions made the discussions even more vibrant. Almost 100 participants joining at the beginning, which is a great involvement and participation. Session like this remind us of the importance of continuous learning and the joy of sharing knowledge. With that, I once again express our gratitude to both the speakers for today, who gave us their valuable time and insights, and to all of you for being part of today's session. Thank you.
Thank you, Nidhi, for
Thanks, sir. In
yeah,
Bharat
elaborate
bhai,
vote of thanks.
words
Thank you.
કે નટુ ભાઈ મજા
It
આવી
was
ગઈ.
pleasure. Yeah. Thank you.
Thank you so much, Ujwal bhai
Our
and
pleasure.
Natwar sir. Thank you so much. Thank you to all the participants. I will formally end the meeting.